Alright, welcome everyone. This is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'll be showing you the three main ways you can manage a short option strangle. And the three methods you're about to see do not have to be used completely independently. You can use a combination of all the methods if you want to adjust your strangles. Now, as always, before we get started, for those of you who are new to the channel, I just want to let you know that I do also teach on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out, and when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. Okay, so what you're seeing here is basically a 3-month price action chart of the company Roblox. Normally I show a 1-year price action chart, but this company hasn't been around for very long. Right, this company IPO'd back in March of 2021, this year. And the reason why I'm showing you this stock here is because if we go into the trade tab now and go into the July expiration cycle, I currently have a strangle on this stock. Specifically, I'm short the 110 strike call option and the 70 strike put option. And so far, as of right now, there is no need to manage this strangle because the stock price at 93 bucks per share is still pretty much right in between my strikes. But that can certainly change any day, right? If Roblox has a massive rally at some point soon, it could blow through my call strike at 110, or if it sells off hard, it could blow through my put strike. And in those cases, I need to do something. So the first method of managing your strangles has to do with rolling. And I'm referring to rolling in the sense that I can roll the untested side, which I'll explain in a second, and also roll the contracts out in time. So for example, let's say Roblox has a massive rally and it goes from 93 bucks per share and blows through 110. In this case, what I can do is roll up the untested side, roll up the put side to collect additional credit. And this is important because the more credit I can collect on a strangle, the further the stock can breach my strikes without causing much of an issue. So in the case of this strangle, I sold this one for about 550 bucks in credit initially. So that means right off the bat, my break-even points are $5.50 above or below my call and put strike. So even if come the expiration date on July 16th, if Roblox is at 115, I will actually still walk away with a small profit. And same thing on the put side, if Roblox is down to 65 bucks per share on the expiration date, again, I'll still walk away with a small profit. And so this is why in our example, if Roblox did breach my call strike, and let's say it pushed to 115 and it was getting very close to my break-even point, then I could buy this put option back and sell a new put option closer to where the stock is actually trading. And let me actually demonstrate this here. So I'll go to sell and then vertical. Let me scroll down a bit here. So this order down here is going to sell one put option contract with an 85 strike, and then it's also at the same time going to buy back one contract, and it's going to be the 70 strike put option right here. So again, this is how you roll up the untested side. I'm buying back the put option I sold initially, and then selling a new contract closer to where the stock is actually trading. And as you can see down here, I would collect an additional 425 bucks in credit. Now this is not a perfect example because the stock is actually only at 94 bucks per share. If Roblox was actually at 115, then I would collect a lot less credit than 425 bucks. But I would still collect a credit nonetheless. It might be 200 bucks, it might be 150, I can't say for sure, but it 100% would be an additional credit. And like I said, the whole point of this is to push my break-even points out even further. And so then after placing this order, I would now be short a more narrow strangle. So the risk here is if the stock whipsaws me, if it blows through my call strike and then turns around and blows through my put strike, that could be problematic, just depends on how far it whipsaws back to the downside. But that's just how this works. When you want to make an adjustment and take in additional credit, you have to give something up. And what you're giving up, at least in part, is your probability of making a profit. Right? With a more narrow strangle, there's a more narrow zone now for the stock to fluctuate in to then make a full profit on the trade. But sometimes you will have no choice but to do this. If the stock just keeps pushing beyond your strikes, you have no choice but to do something, right? Because with strangles or naked call options or naked put options, you have undefined risk. There is no cap as to how large your losses could be. So at some point, again, you have to give something up, make an adjustment, to prevent yourself from having massive losses. And so going back to our example now, let's say after Roblox blasted through my call strike, it did whipsaw me. Maybe it got to a high of 120 and then it fell right back down and blew through my put strike, specifically my new put strike at 85 bucks per share. So again, applying the same principles here, I roll the untested side. And in this case, the untested side is the call side. So I would roll the calls down and collect more credit. So let me delete this order right here. And perhaps now I wanted to roll the call all the way down to the same strike as my put and convert my strangle into a straddle. And so I can click on the 85 strike call option, go to sell and then vertical. And so you can see down here, I would sell one contract, 85 strike call option, and then at the same time, I would buy back the 110 strike call option right there. And as you can see, I would take in additional credit for doing this. Now, sometimes the stock can whipsaw you so much that by rolling the untested side, you actually make things a bit worse. In which case, what you can do is roll the whole thing out in time. And in doing so, you can adjust your strikes in the process. And when I say out in time, I'm referring to moving this strangle into the next expiration cycle, which would be August in this case. So I can go back to the monitor tab real quick and right click on my Roblox trade and go to create rolling order and then sell one double diagonal. Click on that. And so you can see down here, this one order is going to take care of everything at once. We're going to buy back both contracts, the 110 strike call option and the 70 strike put option in the July expiration cycle, and then also sell the 110 strike call and the 70 strike put in the August cycle. And once again, you can see I could do this for an additional credit. And this is what allows me to also adjust my strikes a bit if I wanted to. So for example, if Roblox was really giving me a hard time to the upside, if it was already through my call strike, well then I can try moving this entire strangle upwards in the August cycle. So instead of selling the same 110 strike call option, I can sell maybe the 115 strike call option. And then for my put, I can move that up as well. And perhaps I'll go to the 75 strike put option. And there we go. Still collecting an even greater credit now actually. And I've been able to move my entire strangle to follow the stock higher. And I can do the same exact thing if the stock went lower as well and I wanted to move my strikes downward. So this is the rolling approach. You start by rolling the untested side, and then if things get too messy, you roll the whole thing out in time. And in the process, you can adjust your strikes as well. The key idea with this method is to continually collect more and more credit to push your break-even points further and further away. But this approach still leaves you with undefined risk, right? There's only so much taking in a few extra $100 in credit can do if the stock were to double or triple in price. And I've seen that happen a few times. And in those cases, although they are very rare, the losses you will face can still be very enormous. And so that brings me to the second way you can adjust or hedge a strangle or any naked option strategy. And that would be to either buy or short shares of the stock at certain price points. So for example, let's reset here. Again, I'm short the 110 strike call option, the 70 strike put option, and let's say Roblox has a massive sell-off and it just blows through my put strike here. Well, what I can do in this case is I can short shares of the stock, right? Because think about what a put option as a seller, when you sell a put option, what obligation are you entering into? When you sell a put, you are obligated to purchase 100 shares of the stock at the strike price if by the expiration date, the stock is below the strike price. And now when you short shares of any stock or ETF, the way you close out of that short position is you buy the shares back. So let's walk through a brief example here. I'll move this over here. So again, I sold the Strangle for $550 in credit, but to make the math a bit easier, let's just round down and call it an even $500 in credit. So perhaps once Roblox hits my break-even point, I want to short 100 shares of stock. And in doing so, I would completely hedge or cover my short put over here. So if Roblox sells off and hits a price of $65 per share, my break-even point, at that point I short 100 shares of stock. And in case you are not fully aware of how shorting works, I essentially borrow the stock from my broker. I then immediately sell the stock in the market for the current price at $65 per share in our example. And then like I said, I would eventually buy the shares back and then return them to my broker. So if I short 100 shares at $65 per share, that's going to bring in a credit times 100 of 6,500 bucks, right? Because again, I first sell the shares. So that brings in cash. Now let's say by the expiration date on July 16th, Roblox sells off even further down to maybe 40 bucks per share. So if I did nothing, if I never hedged this put option, that would be a massive, massive loss. But because I shorted those shares ahead of time, when Roblox was trading at 65 bucks per share, the losses are actually going to be very manageable. And in fact, I will actually break even on this trade, right? Because again, selling a put option contract means I have to purchase 100 shares of stock at the strike price. So now if I have to buy back those 100 shares at a price of 70 bucks per share, that's going to cost $7,000, which means the net effect here is I lose 500 bucks, at least in regards to trading the stock. But don't forget, if I sold this Strangle initially for 500 bucks in credit, I actually add 500, and the ultimate total outcome is I completely break even on this trade. Whereas if I did nothing and by July 16th, Roblox is all the way down to 40 bucks per share, that would be a loss of $3,000 from the stock, which can then be offset a little bit by the credit I took in initially from the Strangle of 500 bucks. So in the end, if I did nothing, the loss would have been $2,500. And in case you're wondering how to hedge a naked call option, on the call side of a Strangle, instead of shorting shares of stock once your strikes get breached, you would just buy shares of stock. And that's because when you sell a call option, you are obligated to sell 100 shares of stock at the strike price. So if you already bought those shares at some point previously, prior to the expiration date, then of course you're in a position to sell them if you have to. And so this is the approach in particular that I'm currently pursuing and testing out in my own trading. And I'm actually combining both the hedging approach with stock in addition to the rolling approach, with the exception of I'm not going to be rolling out in time unless it's in very specific circumstances. The reason being is sometimes when you hedge a naked position like this with buying stock or shorting stock, the stock can definitely turn around and come back in your favor. So in the first example, if I shorted shares of stock at a price of 65 bucks per share, but then Roblox started to rally, at some point I need to get out of that short position, otherwise I'll be taking on losses. And when that happens, when I do take on small losses from having to hedge shares of stock, well, I can compensate for those losses by rolling in the untested side and taking in additional credit. So like I said at the beginning of this video, you can definitely combine these different approaches if you want to. And then the final way to adjust or manage a short strangle strategy is to simply cut losses at a certain point. And a common way for doing that is cutting losses at a certain multiple of the initial credit received. So again, if I initially took in 500 bucks in credit for selling the Strangle, then if I wanted to cut losses at, let's say, 2 times the initial credit, well, 2 times 500 is 1,000. So if my losses ever hit $1,000, I will simply get out of this position. And this is something I was actually doing previously. Previously, I was cutting losses at a certain multiple of my initial credit and also using the rolling approach at the same time, right? Because also when you roll the untested side and also out in time, the price of your entire position is going to move more slowly. And that's all based on the deltas of your contracts. So right now the delta on my call option is 33. The delta on the put option is 11. So the combined delta for my entire Strangle here is 22. 33 minus 11. And that means I will take on losses faster if Roblox pushes even higher. And so what I can do to combat that is roll up the put. Again, I can move my put from 70 to a strike of 85. And I would take in some additional credit for doing so. And also the delta on this put option is now 31, which almost entirely cancels out the delta on the call option. So at this point, as Roblox moves around, the price of the Strangle is going to move very slowly. And that will help a lot to slow down the losses if I am in a losing position so that I'm not forced out of the trade if it ever hits my stop loss point. And so there you go. Those are the 3 main ways you can hedge or adjust a Strangle. There's the rolling method where you either roll the untested side or you roll out in time. There's the stock hedge method where you either buy or short shares of stock to hedge your obligations on the contracts, or there's the stop loss method where you simply cut losses once those losses hit a certain point. And again, you can definitely use a combination of all this as well. There is no one correct answer, one correct approach. When it comes to selling options, it's all about maximizing the amount of credit you can keep on average and also minimizing your average losses. And all three of these approaches, all three of these methods can help you achieve that. So with that being said, that concludes this video. I hope you enjoyed it, and please let me know your thoughts or if you got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.